This video will introduce settlement and margin concepts for futures contracts. We'll look at initial margin, maintenance margin, and variation margin. Then I'll provide an example of daily settlement and margin accounting for T-bond futures contracts. Then we'll look at position accounting for futures contracts. And position accounting is really trying to calculate, well, what's the open interest on a position in futures contracts? How many contracts are outstanding? That's what we'll look at. And then we'll provide an example of position accounting using 30-day Fed funds futures contracts. So now let's go into daily settlement and margin concepts. So I'm about to present a problem where we have a Treasury bond futures contract that we're going to look at margin accounting for. And before we get into that problem, it would be helpful, I think, to make sure we're all on the same page as to what a bond represents. And I cover that a little bit when I do the problem. But then, what does a bond futures contract look like? And, how does it work? And what's the big picture? Well, here's what's happening. Best thing to do is set up a timeline. And so we're going to start off at time 0. And let's say in 9 months, the futures contract matures. 9 months later, 9-month contracts. Right here. Now we're sitting right here in today at time 0, and we know we're trying to figure out, do we want to enter into a bond futures contract? And we're going to think about it for the moment as going along. That means, do you want to buy a bond, Treasury bond, right here at this point, 9 months from now? So you're going to enter into an agreement to buy it 9 months from now. And let's say the futures price that we observe is 92. Now that's often the way they're quoted. That means it's 92% of the face value of the bond. And bonds usually would have a face value of $1,000, so this translates into $920 per bond. Just as a convention on how bond prices are often quoted, it's a percentage of the face value. So the bond is selling at a discount. If it's sold at $1,000, it's sometimes called traded flat. But this bond, this futures price for the bond is 92. And here we think the best guess of what the price of the bond will be at this point is $920. That's the best guess based on projections for interest rates. So when you enter into a futures contract here, and it's for a transaction that happens at this point, the futures price is going to reflect people's best guesstimate as to what the price will be at this point. So people right here today are projecting that Treasury bonds will cost $920 at this point in time. Now, let's think about it in terms of interest rates. So here we have, so let's assume time rolls around, 9 months go by. We're right here. 9 months go by. We're right here at expiration. And we're locked in. We will pay $920 per bond. Okay, per bond. And a contract for Treasury futures are 100 bonds per contract. So you're going to have to multiply that by 100 in order to come up with the contract size. So it'll be $92,000 for the contract size. So we're going to pay this. But we don't know. We'll know at this point that we're going to have an actual bond price for the treasuries. What is the actual price as of this date? And let's say, the price is $980. Ooh, that's great, because we're going to pay. We locked in at this point to pay $920. The bond actually turns out at this point to be $980. We just made $60 per bond from this futures contract. So we're going to pay $920, and somebody, the person on the other side, the person who's short the contract, will deliver a bond, and it'll be worth $980. We just made ourselves a $60 profit. So that's what futures contracts can do. But you remember now that in order for the price of the bond to go up, interest rates had to fall. So if you could predict where interest rates are going, you have yourself a money machine in the bond market. And here, we'd have to sit here, and let's say this $920 is based on interest rates being at 5%. So we're sitting right here. We're going to buy a bond, enter into a bond futures contract to pay $920. because interest rates are expected to be 5% here. But let's say we're right here and you have a better crystal ball than everybody else's. Your crystal ball is clearer than everybody else. You can foresee the future better than other people, because other people are setting this 9/20 price for this date. But let's say you expect interest rates to fall. They're going to fall over this time period here. And if they fall, let's say they fall to 3%, maybe the price goes up to 980. So in other words, you can forecast and set prices in dollars, but you can also look at things from an interest rate perspective. And that's where I said, like, look, if you know how to predict interest rates, you basically have a money machine, because interest rates determine prices and prices determine interest rates. So it doesn't matter which way you go, but ultimately you want to get dollars. You want to get dollars, and that's exactly, you want to gain in terms of dollars. And that's what we're doing here in this transaction. So now, so what is the underlying now exactly? And that's a good question. What is the underlying to a Treasury bond futures contract? Well, what normally has to be delivered is a Treasury bond. But then, there's a degree of flexibility that you can have in what you can deliver. And so the bond has to be at least a 15-year maturity and no more than 25 years, and it can have a variety of different coupon rates associated with it. So you need to look up on a schedule which bonds are eligible for delivery to fulfill a Treasury bond futures contract. So if you're short the contract, you're going to have to come up with Treasury bonds to deliver them, because this person right here has got the long position. They're going to buy it here. And somebody has to sell it to you. Somebody has to deliver you that bond, because Treasury bond futures contracts are what's called deliverable. Deliverable means that they're going to deliver the underlying asset. And so the underlying asset is a Treasury bond. And, like I said, there's flexibility as to what interest rates and coupon rates and the maturities that can fulfill a contract. And there's slight price adjustments for that. So if you give a bond that has a higher coupon that's a little more valuable, then there'll be price adjustments. So nobody on either side, the long or the short, gets hurt. I mean, there'll be a little discrepancies, but for the most part, there'll be price adjustments for that. And the reason for that is if you specified, for example, that it has to be a 20-year Treasury bond with a 3% coupon, the problem with that is that there may be a scarcity of these bonds at maturity. And not only that, but somebody could be trying to do what's called a short squeeze. What they'll do is they'll recognize that there's millions of dollars worth of Treasury bond futures contracts that require delivery of a 20-year 3% coupon Treasury. And you know what they'll do? They'll go out in the market and they'll buy all of them up. And if they buy all of them up, the underlying is not available at this point. And then there's what's called a short squeeze. The price goes up dramatically, and it makes it really hard for the person to deliver it, the short person. Because this person who bought up all these things is going to charge a really high premium to unload those things. It's called a short squeeze. So my point is of this story is that there's a lot of flexibility as to what bonds can be delivered. So there's no one particular bond. Nobody can really do a short squeeze and buy up all of the 20-year 3% coupon bonds and make them really scarce. The same thing would happen, by the way, if you looked at corn futures. So you can enter into a corn futures here to buy corn 9 months from now, and it's going to be number 2 yellow corn. But what if there's a shortage? What if there's a short squeeze and somebody bought up all the number 2 yellow corn that can fulfill the contract? Ooh, then there's a short squeeze going on. And the person that's short the corn and has to deliver it for the futures contract, they're going to have to pay an extraordinarily high price to get their hands on the underlying for delivery in order to fulfill the contract. So what do you do in those cases? Well, there's flexibility built into the system, so to speak. The people who are short the corn, they can deliver number 1 yellow corn, which is a higher premium, a higher quality, or they can deliver number 3 corn, which is a slightly lower quality. But the point is, it's very hard to corner the market in number 1 corn, number 2 corn, number 3 corn. So there's flexibilities built into the system. And the same thing applies to the the treasury bond market. Okay, so that's an introduction to the problem that I'm about to unpack and explain on margin and daily settlement procedures. Now keep in mind there's various forms of margin, and I'll explain that in the problem as it unfolds. But just to give you a little bit of background in it, there's initial margin, which is basically a good faith deposit that you'll fulfill the contract. So if you're long the contract, you'll actually buy the treasury bond here. So the problem that people have, and the clearinghouses and the futures market in general, means, look, you can enter into a position long, but it's 9 months later when the transaction actually takes place. How do you know this long position, this person who's long, is actually going to be able to fulfill and buy that underlying asset? Well, that's where the margin deposit comes down, initial margin. It means that you're going to have good faith. This person who's long is going to have putting a good faith deposit that they can actually buy it in the future. And then the problem becomes, well, what happens if the value of the underlying asset drops off? So you're locked in this case, to pay $920 per bond. But what happens if the bonds actually drop? They don't actually go up, but the bonds you're going to get are now worth $200. Ooh, can you imagine that? You're locked in to buy bonds at $920, and they're only worth $200 because interest rates skyrocketed. They went way up over the past 9 months. You know, this person here, they're not going to want to fulfill the contract, pay $920 for something that's worth $200, because they're going to lose $720 per contract. It's possible these guys could go belly up. So how do you handle that? Well, that's where variation margin comes into play, maintenance margin. If the value of what's being purchased over this time period starts to decline, then the long position has to post more margin, more good faith deposit, so to speak, as the price declines. And if the price actually goes up, they actually get more equity in the transaction, and they can actually withdraw money out of their account. But the mechanism here is you want to make sure that people can fulfill their side of the transaction in the future. And margin requirements kind of help that out, gives them an incentive to be able to transact at this point. So what's really good about the financial markets in this respect, in the futures market, is these contracts every single day are marked to market. They determine a market value every single day. And if the bonds start losing value, then the long position is going to have to start posting more and more equity. Not here, not somewhere here, but if it starts losing money right here, you're going to have to start posting money as the long position, post money to put more equity into the account, build it back up, because people know you're sustaining a loss. You're going to get hit with a $720 loss at this point. It'll become realized. But look, right here, it's actually becoming realized because the long is going to have to put up more equity, more variation margin all along the way. And then if things rebound and this price goes way up, then somewhere along the way, the long position will be able to extract money out of their account because they're going to get a bond that may be worth $1,200 and they're paying $920. Well, that's kind of a good position to be in. That long position has a lot of equity in this transaction. They don't have to wait to this point to get the money. They can start withdrawing money sooner. And so you can add money and you can delete money for variation margin into accounts. Also, keep in mind that the party that's short also has to post margin because things could go bad for them. If they have to deliver a really expensive treasury bond like I was talking about earlier, that's going to make it very hard for the short seller to actually deliver that bond, in which case they're going to have to pony up more and more margin as time goes on to eliminate the risk involved in that transaction. So that's an introduction to margin, especially around treasury bonds. And so now let's actually dig into an example. So probably the best way to introduce daily settlement and futures margin is to use an example. So here I have an example with a story to it, and it motivates the use of bond futures contracts. So it gives you a little more insight than just having a pure raw problem that covers daily settlement and margin. So let's read here and we'll give you the background to the problem. The portfolio manager of long-term Treasury bond mutual fund learns today that she will receive $1 million in 3 months. Okay, so you have a portfolio manager. What's she managing? A portfolio of bonds in a mutual fund that's called long-term Treasury bond mutual fund. Okay, she's managing a portfolio. She expects to get $1 million in 3 months. Now, the portfolio manager has a great reputation for predicting changes in the yield curve and presently foresees long-term interest rates dropping in the near term. So she decides to lock in the high rates, in other words, low prices today, by buying 3-month T-bond futures contracts. It's buying, actually entering into, okay, but it's slang, buying 3-month T-bill futures contracts with $1 million in face value. So let's look at this a little more carefully. So now remember, when interest rates are high, bond prices are low. So you want to buy bonds when the interest rate is high because you're going to get a high yield, and that means the price is going to be low. So there's that inverse relationship. So this portfolio manager expects to get $1 million in 3 months. But you know, if she can predict the yield curve, and what the yield curve means is she can predict future interest rates. That's really what the yield curve is about. And she foresees interest rates falling. So she wants to lock in low prices and high yields now using T-bond futures contracts. So another really interesting angle in which to look at this problem is that $1 million that's going to be received in 3 months, that is at risk in the sense that, you know, if bond prices go up in the next 3 months, that $1 million is not going to buy that many bonds. So why not lock in the price of bonds now and eliminate that risk of prices going up? So that's the setup. Now the contract size is $100,000 for each T-bond futures contract because the contract size underneath it is 100 Treasury bonds. Okay? A Treasury bond is usually denominated in $1,000, and so there's 100 of them. So the contract size in terms of dollars, the face value of those contracts for each contract is 100,000. Since she needs to hedge or reduce the risk associated and make some money, hopefully, on $1 million worth of bond money, she needs to buy 10 futures contracts. So you take $1 million, divide it by 100,000, that's 10 futures contracts. Now, let's look at futures prices here for Treasury bonds. The futures price is 92. Okay? So what that means is it's 92% of $1,000 face value. So if you have $1,000 face value bond and the price is 92, it means the price is $920. They just chopped the zero off. So it's $920 or a price of 92. Okay, there's the setup. That's what the futures price will be that this person's going to lock in. Now, initial margin is $5,000 per contract, and maintenance margin is $3,750 per contract. Now, let's talk about what initial margin is. Initial margin is basically a down payment or a deposit, essentially. A good faith deposit that if you enter this futures contract, you're going to fulfill the contract when it expires. And you're going to actually, in this case, buy the Treasury bonds. Okay? That's what the $5,000 is per contract. So 5,000 times 10 contracts. The portfolio manager here is going to have to put a down payment, so to speak, a margin payment, initial margin payment, which is equity of $50,000. Now, maintenance margin is $3,750 and per contract. And what that means is if the account balance for each contract falls below $3,750, in other words, the initial margin is $5,000, if the value of that position drops to $3,750 per contract, there's going to be what's called a house call or what's called variation margin. The portfolio manager is going to have to pony up some money because the market's moving against her. So that's the background. Now, suppose the futures price is quoted at 93, 96, 91, 88, 84, and 87 on each of the next 6 days, respectively. What is the gain or loss, the margin call, if any, which is the variation margin, and the margin balance each day for the T-bond futures position. And then afterwards, we'll do a reconciliation of what's going on here. So this is an interesting problem. It's going to be all about daily settlement and how futures contracts are marked to market every day at the end of the day. And then if you're short and you lost some value in your position, you may have to post some margin. And we'll assume that the portfolio manager has to post margin the next day. So they determine the margin in day one, but in the second day, the actual margin, the actual money moves and gets deposited in an account. Or it could be withdrawn in an account. So now, with this background, let's work this table. And so now I'm going to go to a marker and actually fill out this table. And when we do it, you'll have a better understanding how daily settlement works and marking the market, futures contracts, and the margin concept. So here I have the table reproduced that's in the notes. And here, let me read across the top. We have day, and we start off at day 0. We purchased the futures contract, the Treasury bond futures contract. I say purchase, but we really went long. We entered the contract, day 0. Then we have day 1, 2, all the way to day 6. Then we have the quote, which is the price per bond. And when I say quote, it's basically the settlement price, the price at the end of the day. Then we're going to figure out the gain or loss for the day. We're going to figure out what is the initial margin. And initial margin is your initial good faith deposit that you'll fulfill the transaction. And so that happens when you initially enter the futures contract. Then there's variation margin, because if the value of your margin account, which is your equity in the transaction, when that falls, you may have to pony up more money to your broker, because basically, your position is kind of going underwater, and the broker wants to make sure that you can fulfill the contract and fulfill the deal. So they're going to ask for more money down. And so you're going to have variation margin, which you're going to add or delete. And delete means you can withdraw money out of your account. If you have a lot of equity, you have a lot of value in your account because you had really big gains from your position, then you can withdraw some money. That's what delete means. So this is the ending balance here, the last column. It's kind of like your equity in a position. So let me go through and explain with the example. Now recall, we have 10 futures contracts, Treasury bond futures contracts. Each contract does 100 bonds, and then the face value of a bond, if you can't read that, that says the face value is $1,000. Okay, so let's look at day 0. Day 0 is when we enter the transaction, right at the end of the day. We're going to assume we enter the transaction at the end of the day, so there's no gain or loss. And the price we pay is 92, or we're going to pay. Now remember, this is a futures contract. You don't actually pay this amount. So you got to be careful with my language here. The price that we enter in when we enter this contract is going to be 92. It's the futures price that we lock in. Now, there is initial margin of $50,000. That's because initial margin is $5,000 per contract times 10 contracts, $50,000. So the margin account, the equity that you have in this account, is $50,000. Okay, so remember now that this is the quote per bond settlement price. A 92 really means it's $920. It's 92% of this face value of $1,000. So $920. Each contract is 100 bonds. So each contract's basically $100,000 times 0.92. The contract's worth $920,000 worth of bonds underlying it. Okay, so now that's the price we basically locked in. Now the next day after we enter the transaction here, the next day, day 1, the price goes up to 93. So it basically went from $920 per bond to $930 per bond. And so the way to look at that is, one way to look at it is you got 0.93, which is 93% of 1,000, minus 0.92. Each contract's worth 100,000, so we multiply that by $100,000. times 10 equals a gain of $10,000. Now you could have taken 930 minus 920 and multiplied it by 100 bonds per contract times 10, and you will come up with $10,000. That's just another way of writing it out. But here I got it out, same thing. Just different way of presenting it. 93% of 100,000 and 92% of 100,000. Okay, so what that means is, look, the account went up to $60,000. You had this portfolio manager gained $10,000 in the position from this. And so there's no margin deposit or anything. It's just that you have more equity in your account. Your balance went up $10,000, which is good. That's good. Now the next day, things go even better. And so the gain is going to be 96 minus the 93. Look at it in terms of percent. Multiply by 100,000, and there's a multiply right here, a multiplication of 100,000. I didn't put that multiplication sign in. I guess I could put it right there. And then you multiply this by 10, and we're going to have $30,000 for a gain. And, well, things went with us, so to speak. They didn't go against us. They went for us. And so there's no margin deposit, because things didn't go against us. So this is now $90,000 we have in the account, which is good. Now, look what happened. It goes from 96 to 91, and it even falls below this 92. So let's see what happens here when we do this calculation. And ask ourselves, will there be a margin call? There'll be a margin call if we fall below the maintenance margin, and the maintenance margin is $37.50 per contract times 10, which means if the account balance goes below $37,500, we're going to get a house call. And when we get a house call, we have to bring the balance up to initial margin, which was $50,000. Okay, so let's ask ourselves, will we have a house call here? So let's figure out our loss. 0.91 minus 0.96 times 100,000 times 10. And we have a loss of $50,000. Okay. Now, a loss of $50,000 means we now have $40,000 in margin. Now, the question is there a house call? And the answer is no, we haven't fallen below the $37,500 maintenance margin account. So this is like a line in the sand, so to speak. If you fall below this equity amount, you're going to have to post margin. There's no need yet. We're getting close, but there's no need. Now let's look what happened. Things went against us. And as you can see, it dropped 3 points, which means it's another $30,000 loss. Same calculation basically as we had here, except it's a loss. So do the math, and you'll come up with a $30,000 loss. And we come up with a $30,000 loss. Look at that. We have a balance here in our margin account of $10,000. That is below the maintenance margin, so we're going to get a house call. Now remember, the house call comes the next day. We need to pony up money right here, and we're going to pony it up at the end of the day. But before we do that, let's figure out the gain or loss for this day. The gain or loss for this day is we're going to lose $35,000. That's a loss of $35,000 because it went from 88 to 84.5. So to do similar math to what we did up here, you'll get this amount. And so now what we need to do is we need to get this up to $50,000. Okay? So we need to post $40,000. And notice, this adds up to $50,000. See, that's $50K. That's good. So why did I bring the account balance up to $50,000? Because once you hit the maintenance amount, which is $37,500, it triggers a house call. And usually most brokers expect you to bring the margin requirement back up to initial margin, which is $5,000 per contract times 10 contracts, which means we got to get it up to $50,000. And that's exactly what we did. We added $40,000 to the account plus the $10,000 gives us $50,000. We ignore for the moment that negative $35,000 to the left that we lost for that day. We ignore that for that margin call of $40,000. Now we have this loss. So we have $50,000 at this point. Now minus 35, we have $15,000 in the account. Ooh, that tells us there's another house call. There's another margin call because we're below the 3750. So we're going to have to pony up 35,000 to get this to be 50,000. See, that's 50,000. But there's going to be, looks like there's going to be a gain here. And the gain will be $25,000. And so this is going to be 50 plus 25. We end up with $75,000 in margin at the end of day 6. So now let's try to reconcile this to make sure we did everything right and we have a good grip on the ideas here now. So notice what happened. We had 50,000 in initial margin. We had 75,000 total right here in variation margin. 75,000 variation margin. We had an ending balance of 75. We had a starting balance of 50. And we had gains and losses that total a minus $50,000. And you can check that because look, it's $5 loss, right? Or you could say $50 loss times 10 contracts times 100 bonds. We lost $50,000 on this position overall. So now let's reconcile. So we have a 50,000 that was initial margin. Then we had a $50,000 loss right here. Then we posted $75,000 in variation margin. That's a house call. We had $75,000 worth of house calls. And what did we end up with? $75,000 is the ending balance. It matches. Ending balances matches. We can reconcile it. So now we're pretty comfortable we did our math right. And we reconciled gains and losses against the initial and variation margin and the ending balance. So this is an example of daily settlement. Every day the transaction settles, and when things start to move against you, or in this case the portfolio manager, you have to pony up more money. And why does that happen? Well, it reduces the risk to the clearinghouse, because if you default, the clearinghouse is going to have to back up your position, and then the clearinghouse is going to go after your broker. So your broker is going to want to collect the money from you and funnel it down to the clearinghouse. So that's the whole point of this. Margin reduces risk in the futures market. Now let's cover the opening and closing of options and futures positions. An opening order in options or futures means that while you have no current position, you're going to take a long or a short position. The best analogy I can make to hit this home, it's a little more concrete for you, is if you have no position in Amazon stock, you don't own Amazon stock, you have no position in it, you don't care if it goes up or down, you're neutral. Now, if you decide to take a long position in Amazon stock, that means you're buying the stock, you're going to be an owner of the company, and you're going to make profits if Amazon stock goes up. Now, if you instead take a short position in Amazon, then you've sold it and you expect to buy it back in the future, you're going to make money when the stock drops. So the same thing's going on here with futures contracts and options. If you go long, you bought the contract or you're going to buy the underlying. And if you took a short position, you're going to deliver something. So now the question is with options and futures, the difference here is that options and futures expire eventually. When you buy a stock, it doesn't ever expire. So you don't have to worry about it. You can hold it forever. But with options and futures, they expire. And we need to consider, well, okay, besides expiration, what else happens? How else do you close a position? So let's cover all the bases here on how to close out a position in options and futures. And that's what I have in the middle of this slide here. Let's look at options first. The first thing that you can do to close out a position is to exercise the option, which means you're going to take or make delivery of the underlying or settle it in cash. So remember, with options, you can take delivery. If you exercise a call option, you're going to take delivery of the stock, for example. And if you're short a call option, you're going to make delivery of the stock because you're going to be selling it and somebody on the other side will be buying the underlying stock. So that's exercise the option. Now, when we talk about delivery, we mean that the underlying asset is deliverable. But if you recall, I've talked about S&P 500 index options that settle in cash because nobody wants to try to deliver all 500 shares of stock in the S&P 500. It's too cumbersome. And nobody wants to take possession of the 500 stocks either in the right proportion. You may get a couple of shares of one stock and half a share of another and a tenth of a share of another stock. It's too difficult. So index options often settle in cash. So you exercise the option. The point is here, you exercise the option, either take or make delivery of the underlying if it's deliverable, or it just settles in cash, the difference between the value at the day you exercise it versus the exercise price. Now, the second thing you could do is you could literally just let the option expire. If the option is out of the money at expiration, you let it expire. The option just disappears. The third thing you can do with an option, and this sometimes throws students for a loop, and it's really not that hard, is that, look, if you bought the option somewhere along the way, you can sell the option. And selling an option sometimes is the optimal way of getting out of a position. The optimal way to close out an options position is often to sell it. And we'll see that when we look at option valuation. But think about it. If you sell an option and it's out of the money, it has a little bit of value left because it could go in the money. And so when you sell an option that's out of the money, it's going to have some value. And also, even if the option is in the money, you're better off selling it because there's still a little bit of extra value in that option because whoever buys it will be expecting the option to go further in the money. And so you can get a little bit of extra money by selling the option instead of exercising it. People who exercise options early before they expire are basically throwing away some value of the option. It's sometimes called time value. And we'll talk about that later, so don't get hung up on it right now because we haven't covered option valuation. But my point again is that selling an option is often optimal, is often the better solution than exercising an option before expiration. So now let's go back to the case of an option that's out of the money. If you exercise an option that's out of the money, you're likely to actually lose money because if the call option has a strike of 30 and the stock is, for example, 20, you're going to exercise the option, pay $30 for a stock that trades on the open market for 20. You're going to lose $10. That doesn't make any sense. So sell the option. You'll get a little bit of value for it because the buyer is going to look at it and say, well, maybe it'll go in the money before it expires. And so it has a little bit of value in those terms. So in some cases, it makes sense to sell an option before it expires. Now, with futures contracts, you can close out a position by taking or making delivery of the underlying or settling in cash. Same situation as with options. Now, with futures contracts, you can do what's called an offset. You can offset the futures position by taking an opposite position. So if you're now long corn, for example, and you're going to take delivery of corn, well, what you do is you go short corn, and now you have no position. You went long, you shorted, and now you have no position. Basically, it's the same thing as buying Amazon and then selling Amazon. You have no position anymore. You're neutral. And if you originally were short, all you have to do is go long, and then you have no position. It's just like shorting Amazon stock and then buying it back later. you have net zero position after that. The third way that you can close out a futures position is an EFP, which is an exchange for physical. That's simply where the buyer and seller negotiate an alternative delivery procedure. And it's just a way to deliver the item and take delivery of the item in a way that's not specified in the contract itself. The contract allows for a negotiated alternative way of delivering a commodity or an asset. So now, with this understanding of openings and closing positions and offset, especially offset, we're going to look at futures contracts. I think it's the cleanest way to do an example. Let's look at futures contracts, and we're going to have several traders, and they're going to be opening and closing positions, and we're going to see ultimately what is the open interest. And open interest is the number of contracts that are outstanding in the market. People look at the number of contracts in the market to get an idea of the sentiment in the market. In other words, how do people look at this? If there's a whole lot of call options in a particular stock, it kind of means that the people in the market that are buying that are very bullish on the stock. So if you saw a lot of call options on Bitcoin, for example, that would mean people think Bitcoin's going to go through the roof. And when stocks tend to go up dramatically, there tends to be a lot of call options on them. And when they drop dramatically, it tends to be a lot of put action in those options. What I'm saying here is that the amount of open interest, the number of contracts and puts and calls, and futures contracts gives you an idea what the market is thinking on a particular stock or a particular asset. And it also tells you the strength behind the price trends. Gives you an indicator of where people think the trends will be. Now, when you figure out and try to compute open interest, an easy way to try to do this to avoid double accounting is just to simply count the number of short positions. Count the number of contracts that are short, meaning the number of contracts where a commodity has to be delivered. You don't want to count the longs and the shorts because it's the same contract. So you'd be double accounting. So what you do is you just count up the short positions, and there you have open interest. So with that introduction, let's go into a problem, an example that shows you how to compute open interest. And we'll deal with offset, and we'll deal with longs and shorts, and we'll deal with opening and closing of positions. So here's a setup for the problem we're about to do. Suppose a new delivery month was just added to the 30-day federal funds futures contract at the Chicago Board of Trade, CBOT. The following table shows the parties and the number of contracts traded over several days. Determine the open interest at the end of each day and the net position for each trader at the end of 4 days. You will need to employ the concept of offset. Okay, that's the background for it. Now, what are 30-day Fed funds futures contracts? Let me explain on paper for a second, and then we'll actually get into filling out this table. So now let me explain what Fed funds are and the Fed funds market. And it has to do with the banking system. The banking system in this country, in the U.S., has reserve requirements. And they've typically been about 10% of deposits, like checking deposits. So what that means is every $100 you and I put into a bank, the bank has to hold on reserve $10 in case people all of a sudden want to withdraw a lot of money out of a bank, that the bank has some cash to be able to pay off depositors on demand. That's why checking accounts are often called demand deposits, because literally the bank is required to pay you back the money on demand when you demand it. So banks have reserve requirements, and sometimes, they can't predict. In fact, a lot of times it's very hard to predict all the movement of money going in and out of a bank. And so there are times when banks are short reserves, and if they're short reserves, the Federal Reserve can shut them down. The Federal Reserve banking system can shut them down because they're making the banking system risky. Because if there's a run on the bank, people want to pull their money out, that bank may collapse because it just doesn't have liquidity. So reserves are like liquidity. There could also be times when the bank has excess reserves. It has too much reserves, and if a bank sits on too much reserves, it has too much liquidity, too much money in the vault, it's an opportunity cost because it's not being lent out. banks need to lend money to make profits, and if they don't make profits, they're going to fold up and go out of business. So banks need to optimize their reserve requirements, and that's where the Fed funds market comes into play. There's going to be banks with excess funds, and there's going to be banks with shortage of funds, in other words, reserves. And so, wow, that's the perfect opportunity to make a market, because there's banks that are going to want to borrow, and there's banks that are going to want to lend. That's the Fed funds market. The contracts are usually big. They're $5 million at a pop. And so the point is now, at times, there are bottlenecks in the Fed funds market and reserves. Historically, you'll see liquidity crunches throughout time, and you'll see examples of that. And so banks don't want to be caught in a liquidity crunch. So they may want to borrow funds, or they may realize that in the future they're going to have excess reserves for some reason, and they're going to want to lend it. So this is how I think you should think of it now here. Draw a timeline. Start out at time 0. Let's just call this January 1st, beginning of the year. So then there's February, and then March, and then April comes around, and there's May. Now we know, for example, that April 15th tax day happens right here. And right around this time period, there can be big bottlenecks in the amount of reserves that are in and out of the banking system, because lots of companies and people are paying their taxes, and the government has accounts with the Federal Reserve, and so money's going in and out of the economy through the banking system, and there can easily be shortages and excess funds throughout the market. So it wouldn't be unusual for a bank to sit here, let's just say January 1st, and anticipate having some liquidity problems in the month of April. So what's it going to do? Well, it can go long in the Fed funds market and agree at this point to borrow money for 30 days, hence the 30-day Fed funds market, or 30-day Fed funds futures contracts. What this position allows you to do, if you're long, it allows you to borrow funds for 30 days. And if it's 30 days, there's going to be an interest rate associated with it over a 30-day period. And there's going to be some interest expense, because you can't just enter into the Fed funds market and get Fed funds and not pay for it. You're borrowing money, basically. And so that's one way to look at it. Now, the bank on the other side would be predicting at this point that they're going to have excess funds, and they're going to lend it through the Fed funds market. So, hence, you're entering into a position right here to go long, in this case, Fed funds for 30 days, and you're going to have access to this funds for a 30-day time period. Now, that's the setup for the Fed funds market, and that's basically how it works. Now, let's go into the problem of position accounting. And one of the interesting things about position accounting is, look, it doesn't matter what the market is that we're looking at, what the contracts are. It could be corn, it could be wheat, it could be silver, it could be platinum, it could be oil. It doesn't matter. So if you don't like the Fed funds concept that I'm presenting, think of it as corn in the example that I'm about to show you. It'll work just fine. But my point here is to give you another story, another example of the usefulness of futures contracts and how the economy works with them. So now let's move on to the example. So here is the problem. We've got day, and we got starting off at day 0. There's no positions, 0, just blanks all the way across. Then we have day 1, day 2, day 3, day 4. We have 4 traders, A, B, C, and D, and they're going to trade amongst each other. They're going to either take long positions or short positions, and I have the number of contracts laid out here. And our goal is to figure out what is the open interest each day down here, and then what is the net position overall for each of the traders after 4 days. What position do they have? Now, let's take a look at Trader A. Trader A went long on day 1. And since Trader A had no prior position, that's an opening position, which means they hope whatever this underlying asset on this futures contract is, and by the way, this is for futures contracts. This is on a futures contract. Somebody went long. They're going to take possession in the future if they hold it to expiration. they went long, and somebody had to go short the transaction. So B, basically, and A entered into a transaction with one contract where B is going to deliver to A and A is going to actually deliver cash to B at expiration. So, how many short positions are there amongst all four traders? C and D did nothing. Well, there's one open position. First of all, by the way, there's 0 here. Nothing happened in day 0. Day 1, there is one open transaction because there's one short position, and it's between A and B. A and B equals 1. That's what I mean by one open position. Now, on day 2, let's see what happens. On day 2, B closes out their position. It's an offset. So B was short, then B went long, so B has no position anymore. So that was an offset. And then when B went long, the person that sold it basically is going to the person who's going to make delivery is trader C. So here's that transaction. Now, how many short positions are there? Well, this short position got canceled, but this one, there's only one short position outstanding. That is with trader C. And so who is long then? Well, it can't be B because B offset. It's got to be A. So there's one open transaction, open interest, and that's between A and C. Now, on day 3, nothing happens with traders A and B, but C and D transact 2 contracts. C decides to go short and is going to deliver to trader D at expiration 2 contracts. So with this in mind, let's see what happens now. Since D has no other positions here, D just opened this position. This is an opening position. And then for C, this is adding on another position. They had opened the position of 1 short, and now they just shorted another 2 positions. So now, how many contracts are outstanding? Well, how many are short at this point? We can cancel these 2 out, just so it's a little easier to see. And then we can say, look, this is open for sure, because this was an opening position, and this person, C, has to have 3 that are short. There has to be 3 here. And then there's a long over here. So 2 plus 1 is 3. And then here's the 3 shorts. Here's the 3 longs. There's the 3 shorts. And now it's between A and C is 1 contract right here. And then 2 contracts are between C and D. And that gives us 3 contracts in total outstanding or open at that point in time, 3. Now, the next day, day 4, A closes out a position. A opened a position here, closed it out. In other words, did an offset. So that's gone. And now let's see what happens. Ooh, trader C closed out 2 of these positions. I don't know which ones of the 3 he closed out or she closed out through an offset, but they closed out. So you can wipe those off. We have trader D offset one of these. So this offsets one of these 2. And so we have 1 here and we have 1 here. So trader D is long and trader C is short. And so it's between C and D have 1 contract that's open on day 4. So now let's look at the net positions, and we should be able to add up to 1 if we go across. So here we looked at figuring out the open interest on a particular day, but that should match up with the open positions of A, B, and C, because if we have open interest here, it's got to be either A, B, C, or D as that open interest. Well, in this case, A opened the position, closed it, offset it, done, 0. Same thing here. B went short and then offset with a 1 here. C went short 3 positions and then offset 2 of them. And so C is short 1 position And D now is long one position. And there you have it. There's the short, there's the long. That's one transaction. It's between C and D. And that's exactly what we reconciled to at the end of day 4. So there you have it, an example of how open and closing and offset works along with longs and shorts of various traders over time.